Thank you everybody for being here for this lecture from Nina Boyarchenko. This is part of the SaMMF lecture series. If you are interested, we already have 2 lectures online from Pierre-Olivier Will, Ben Lasters, and then Brandon Wright. In the next months, we are gonna also have Simon Monge and Marzena Orstek and Daniela Puzzello giving new lectures here. Thank you, Nina, and please take over.
Great. Thanks for having me. Let's see if I can successfully share. And let me go into full screen here. So hopefully you guys can see my slides. And let me know if that's not the case. Today I'm going to talk to you about DOR participation in over-the-counter markets. And as always, the views are my own and not the views of the Federal Reserve Bank of New York or of the Federal Reserve System. So why DORs and OTC markets? Well, first of all, DORs tend to be the central participants in over-the-counter markets. I should say that throughout this lecture, I'm going to be using OTC and over-the-counter interchangeably. OTC is just the abbreviation. And importantly, for what I'm going to discuss today, a small set of DORs are going to be participants in multiple interconnected markets. So it's not just that a particular DOR is a central participant in one over-the-counter market, they tend to actually intermediate across markets. So for example, if you think about the market for trading credit risk of US non-financial firms, DORs are going to be participants in the primary market for US corporate bonds, in the secondary market for US corporate bonds, and a small subset of those DORs are also going to be central participants in the corresponding credit derivatives. Now, I'm not going to go into this today, but if you're interested in this question, please feel free to reach out to me afterwards. One of the interesting things about these DORs is that, yes, they're going to be central in over-the-counter markets for, again, let's say corporate credit risk, but they're also going to be central participants in, or major participants in related products that are traded on centralized exchanges. So in the US corporate bond world, for example, DORs will trade a lot in corporate bond ETFs, which are exchange traded products. So what I'm going to talk about today is the broad question of how does DOR participation in one market affect the DOR participation in other related credit markets. So, and in particular, I'm going to focus on DOR participation in primary and secondary markets for US corporate bonds. Why these 2 markets in particular? Well, first of all, in terms of this question of how does DOR participation in one market affect DOR participation in another market, there is a very substantial overlap between secondary market DORs and primary market underwriters. Now, second, corporate bonds are an important source of funding for US non-financial corporations. In general, US corporations have roughly 2/3 of their debt through corporate bonds rather than bank loans. So understanding how DORs and DOR constraints affect how easily US non-financial corporations can issue, and whether that in turn is affected by what the underwriter is then doing in the corresponding secondary market is crucial for understanding how the ease of access for US non-financial corporations. Now, despite the importance of the primary market, in general, the literature has not really focused much on this primary secondary market interconnection, especially when it comes to trying to understand the role that DORs play actually in that interconnection. And one thing I'm going to show you is that, knowing what is happening in the secondary market is not actually a sufficient statistic for understanding what's happening in the primary market. Again, from the perspective of corporations being able to issue debt period, as well as being able to issue debt at quote unquote reasonable prices. In general, I'm going to start by showing you a framework for how you can think about why secondary market dealers and secondary market trading by dealers can affect primary market access. And then I'm going to show you some evidence on how this actually plays out using intermediation patterns during the COVID-19 pandemic, in particular during 2020. So again, just to give you an idea of how pervasive the overlap is between dealers in the secondary market and underwriters in the primary market, here is a particular list of dealers in the secondary market for US corporate debt. This particular list of dealers are just the institutions that became registered counterparties to the Federal Reserve's secondary market facility during 2020. And all I want you to gather from this slide is if we look at the column that has a yes, no for whether that dealer is an underwriter for US corporate bonds, you can see that a lot of these secondary market dealers are also underwriters at the same time. Now, in terms of secondary market conditions not being a sufficient statistic for primary market conditions, here I'm just showing you two very simple charts. Starting with the chart on the left in panel A, I'm plotting the average offering spreads for 2020, which is the black line, compared to the median over the previous 10 years. And what you can see is that during 2020, especially in the spring and through roughly midsummer, offering spreads for investment grade bonds were extremely elevated relative to the prior 10 years. The event lines in this chart are the first black line is for March 22nd, 2020, when the corporate credit facilities were announced. The second black line is for June 29th, 2020, when the corporate credit facilities were fully operational. Now, if you compare this evolution of investment grade offering spreads during 2020, which rose in March and continued to be elevated pretty much until really the facilities became operational, with the patterns of credit spreads in the secondary market, you can see that there is a disconnect in terms of, yes, it's true that secondary market credit spreads for investment grade bonds as well as high yield bonds, of course, were rising at the beginning of 2020. So again, up until the announcement of the facilities. But then once the facilities were announced, the spreads retraced, the secondary market spreads, excuse me, retraced very quickly, so that if we compare the level to which they wound up retracing by the end of the year, roughly a third of that retracement occurred within the first week of the facility announcement. So, if you're looking at these two charts without any prior knowledge of how these markets operate, you may be wondering what is the connection between the secondary market and the primary market in this scenario. And it turns out that the connection is actually through the volatility of secondary market spreads, as is plotted on the left side chart here. And you can see that, again, during the course of spring 2020, the retracement in primary market spreads mirrored the retracement in secondary market spread volatility. And we're going to come back to this question in the context of the motivating framework. Now, just to be clear, the way that secondary market conditions translate into primary market conditions is not the same over time, or not the same during different episodes. So here I'm repeating the same chart, but for 2008, where the event line is in the investment grade offering spread chart is around the Lehman bankruptcy. And you can see here that the investment grade spreads, offering spreads, followed the secondary market spreads much more closely over the course of 2008, and in particular after the Lehman bankruptcy, both the secondary market spread and the investment grade offering spread continued rising in lockstep. Okay, so let's talk about why, in what sense do dealers link primary and secondary markets? So if you talk to a market practitioner, what they're going to tell you is that, first of all, when we're talking about primary markets are going to price corporate bonds as a spread to on-the-run match maturity treasuries. So what that means is that if we have a company, let's say Apple, issuing a 5-year bond, the yield on that bond at offering is going to be computed as a spread relative to the 5-year on-the-run treasury. And so then the question becomes is how is that spread determined? So in an ideal world, the spread is calculated directly off of secondary market spreads for the same issuer. So meaning, again, just to take Apple as an example, if they're issuing a 5-year bond, the underwriter or the book runner is going to look at where Apple's, let's say 4.5 and 5.5 year bonds are currently trading in the secondary market, and they're going to infer what is the correct spread given those secondary market prices at which you can price a 5-year issue that is, in terms of maturity, is falling right in between those two observed secondary market spreads. Now, of course, in reality, the corporate bond market is not that liquid. So the firms for which you can literally do that calculation where we have 2 bonds that bracket the maturity at which you want to issue, those bonds are liquid enough to actually calculate a spread on an ongoing basis. So usually what the market actually does is they're going to look for issuers that have similar credit rating, that are in a similar industry, and are going to use those comparison firms as a basis for which to calculate the spread. Once a spread is calculated, or a target spread is calculated, there's still the question of the ability to issue. And there are a few things that enter into that. So first, the underwriters or the book runners have to be sufficiently confident in their ability to place the issue. So they're not going to engage in this process with the company that is trying to raise debt unless they actually think they can go to their insurance company clients or their pension fund clients and convince them to actually buy the issuance. So that's one piece of it. The other piece of it is that, and we're going to talk about that when we look at the empirics, is that it's very rarely the case that the exact amount that the issuer wants to issue gets placed with the end clients on the offering date. And so then the underwriters have to cover either the under allocation, meaning the full amount did not get issued to the end investors, and the dealer has to at least temporarily absorb some of the actual issuance, or the case that is more likely is the over-allocation case, where the underwriter actually sells more of the new issuance than the company has actually offered. And then the final piece is that the issuers themselves, once they actually get the estimate from the underwriter about the spread at which they're going to be able to place that particular issue, have to be willing to still issue their corporate debt at that particular price. So again, to give you an idea of how conditions can deteriorate fairly quickly for, very safe companies for which a priori you wouldn't be worried about their business model or their balance sheets. Here's a quote from an article in December of 2009 talking about issuances of the Caterpillar Corporation. If you don't know what CAT is, they essentially make a lot of heavy machinery that's used in construction. And so in 2008, even in August of 2008, they were able to issue 5-year bonds at a pretty reasonable spread to US Treasuries. So 1.75% spread to Treasuries. And then over the course of fall 2008, that spread kept rising and rising and rising, even though, of course, the material prospects for the company hadn't really changed over those 3 months. The article goes on to talk about other companies like Hewlett-Packard, who had a similar experience of credit spreads for their bonds rising without a corresponding deterioration in the company's fundamentals. And basically the issue being that the secondary markets for corporate bonds were pretty frozen at that point. Again, just to give you an idea of how corporate bond markets fare.
Sorry for interrupting. Can I ask you if do you know if the clients, not the dealers, that buy in the primary or trade in the secondary, are they different, like exactly different? Or can you identify their different types of investors or something like that? Or they look the same?
Yeah, so I don't have numbers. I don't have numbers here for this, but usually the clients that buy in primary markets, and this is a generic statement, not just for corporate bonds, they're the institutions that want to hold the bond until maturity. There will be rare cases where, they get allocated more than they thought they would. So they have to enter the secondary market and, sell the excess, or there will be cases where they get allocated less than they wanted, because all of these issuances are run as auctions. So a client has to submit a demand schedule, and then, we all know how auctions work. So in an auction, even though you're bidding for a particular amount, you may not get allocated that full amount, or you may get allocated more than you initially thought you would. And then the activity that happens day to day in the secondary market tends to be done by, things like mutual funds that have to reallocate their bond portfolios, either because of customer flow issues or because they're actively trying to manage their portfolio. So I guess essentially there is some overlap, but it does tend to be a pretty diverse investor population. So you can think about the investors in the primary market as being primarily insurance companies and pension funds. Again, institutions whom you don't think about actively trying to manage their investment portfolio on a day-to-day basis. And then in secondary market, you get hedge funds, you get, the activist mutual funds, etc. Institutions like BlackRock are secondary market participants.
Can I ask a follow-up question on this?
Yeah,
so
please.
yeah, so normally when we are talking about the yield on let's say AAA corporate bond, so are we talking about those those newly issued bonds, or those which are traded on the secondary market, or is a combination of both?
So in the data, when, let's say, people plot, if I understand your question correctly, when people plot, let's say, the BAA spread,
Yes.
that's not necessarily even a trade. So first of all, it's supposed to be a secondary market spread. But in reality, that's usually, it's not actually necessarily based off traded prices. In a lot of cases, the officially published spreads tend to actually be based off quotes and not transactions.
So it's basically about the secondary market.
Yeah.
Okay, thanks.
Right. So again, just to give you an idea of how primary markets for corporate bonds do during, periods of financial stress, let's call it. On the left-hand side, I'm showing you the cumulative issuance by investment grade companies during 2008, again, compared to the same numbers for the prior 10 years. On the right-hand side, I'm showing you the same chart for 2020. And as you can see, during periods of market stress, even investment grade issuance slows down dramatically. In 2020, once the facilities got announced, which again is what this first solid black line is, investment grade issuance started accelerating again, and ended the year much higher than in the previous 10 years. During the financial crisis, of course, given the much longer duration of the financial shock, it took the market much longer to recover. Okay, so let's talk about why it makes sense to think of dealers as linking primary and secondary market. I'm not going to go through all of the details of the solution of this model because it gets a little bit involved, and I do want to get to the data. But essentially, I want to think about an economy where we have three types of agents that participate in the primary market. The first type is going to be the issuer. The second type are going to be underwriters that are also going to be dealers in the secondary market. And then we're going to have end investors. Now, if you're familiar with these types of models, you do need to have some non-fundamental shocks in the model to actually not have full information revelation. I'm going to show you a version where I just have a price insensitive trader present in this primary market that just has demand that is normally drawn, that is a random variable drawn from a normal distribution. You can think of this as, for example, if you have index fund, if you are an index fund and you need to replace a issue that is maturing, so it's going to get dropped from the index with a newly issued bond of the same issuer, you may go to this market, and because you're just replacing and not taking a fundamental position, you're essentially going to ask as a price insensitive trader. Now, this primary market is going to be connected to a secondary market that allows for retrading of primary market allocations. Again, going into the direction of the question that Bruno was asking, I'm going to assume that there is a separate class of, again, clients or agents that have some private values for this newly issued security, and a fraction of the clients that participate in this primary market auction, and a fraction of the underwriters themselves are going to sell into the secondary market. For what I'm going to show you today, again, I'm going to assume that how much is getting issued is known to the underwriters and investors. I'm going to tell you a few possible extensions that deviate from this assumption later. And so if we talk about the three types of participants in the primary market, so first of all, everybody is going to have a private value component. So the end investors, again, are going to have a private value that is normally distributed, and they're going to choose a quantity that they want to buy given the price at which they would be buying that to maximize their expected current normal utility. I'm going to allow them to have some information about the value of the security in the secondary market. And reflecting the way that the primary market for corporate bonds work, they're going to be participating through underwriters. What that means is that the clients have to shuttle their bids for the newly issued bond through an underwriter. This particular model allows for underwriters and clients to share information, but in terms of underwriters actually linking the primary and the secondary market, you don't even need this information sharing to happen. You just need to have this resale possibility to the secondary market. So again, if we talk about the underwriters, in many ways, it's going to be symmetric to what the clients are doing. So again, they're going to have a private value. They're going to have a quantity that they're going to bid for given a particular price. They get their own private signals about the average valuation of new issuances. And again, this model allows the underwriters to actually learn from the order flow of their investor clients. What that does in practice is it reduces the uncertainty that underwriters face about their potential secondary market profits, But as long as there is this possibility of them having to access the secondary market to actually sell the newly issued security, you don't even need to have this learning channel present for the primary secondary market linkages to go through. Finally, the issuer is just going to be choosing a quantity of how much they're going to issue, subject to, to maximize their expected utility of how much money they're actually raising. But they are going to be doing that subject to a minimum revenue threshold, right? So this is the statement that, everybody can issue a 10 million bond at, let's say, 1 cent, but it doesn't mean that you want to actually issue a 10 million bond and only receive 1 cent for it. By the way, there is a student on the market this year, Karasiani from Columbia, who has a paper that is actually thinking about the question of different investors participating in corporate bond offerings, and she also has a slightly different model for how the primary market works. Okay, so to get to the primary market equilibrium, it's going to look very similar to how current normal equilibria work. So everybody is going, or both the end investors and the dealers are going to have a demand that reflects their expectations about the value of having to resell of the asset in case they have to resell, which is what these first two terms are. They're going to, respect their private values, and then of course subject to the price that they pay. And then the denominator just reflects the uncertainty about the resale value and their risk aversion. as well as the price impact that they have when they bid in the primary market, when they bid more aggressively in the primary market. I'm not specifying what the information sets that they have that form the expectation of resale value and the uncertainty about resale value. But basically those information sets include the private signal that each agent has, the information that they can infer back from the auction clearing price, as well as shared information from the underwriter if it's a client, or the information from the client if it's an underwriter, again, assuming we are in the version of the model that allows that. Now, the equilibrium clearing price, again, not surprising in these types of models, is going to be a linear function of everybody's signals, everybody's private values, and this price insensitive demand. And then finally, of course, we need to have market clearing in quantities for the amount that's actually issued, as well as the demand by all of the active agents. So in terms of what we actually get out of the simple framework, so first of all, we already get a direct feedback from secondary markets to primary markets through the beliefs about secondary market conditions, right? So here, you can see very clearly that when expectations about the resale value are higher, you're going to demand more. When you are more uncertain about the secondary market value, you're going to demand less. And these secondary market conditions are going to matter more for the agents that are going to expect to resell more. So if we think about comparing an underwriter in this market to an end investor in this market, the underwriters are going to be the ones that are going to try to trade out of their positions after the primary market auction is completed. I don't have the chart here, but again, in these markets, especially after the financial crisis, dealers don't really hold day-to-day inventory in corporate bonds. And so they're definitely going to try to sell out of anything that they actually get allocated. And so, this is a very simple framework that actually allows you to think about these interlinkages. You can definitely add more bells and whistles on top of it if these are the types of questions you're interested in. So you can think, for example, about models of secondary market and intermediation that then allow you to endogenize this fraction that actually gets resold by the dealer after the primary market auction is completed. I think some of the prior lectures in this series talk about that particular question. You can also think about endogenizing what happens from the end investor side. For example, if you think about the investor risk aversion in this carry normal framework as being related to investor wealth, then that allows a further linkage between secondary market and primary market, because if the secondary market goes through a downturn, you have outflows from bond mutual funds, which depletes mutual fund equity, raises the risk aversion of the mutual funds. And so then again, the primary market is going to take longer to normalize. You can think about models of capital structure, endogenizing this like minimum revenue threshold question for issuers, et cetera, et cetera. So again, I view this, relatively simple framework as basically being a basic building block that allows us to understand, how do secondary market conditions translate into primary market conditions. So I promised to show you some actual data. So the data that I'm going to show you is going to deal with intermediation during 2020. Just to give you a very brief primer on corporate credit facilities, because a lot of what I'm going to be talking about is going to be in terms of how corporate credit facilities actually affected intermediation. So the corporate credit facilities were liquidity facilities established to ensure access to debt capital markets for US non-financial issuers in response to the dislocations in the corporate bond market due to COVID-19. The facilities, recognize that there is the secondary primary market connection. And so they were designed with a two-pronged approach. There was a, a primary market facility that was envisioned to directly lend in the primary market, as well as a secondary market facility, the purpose of which was to improve conditions in the secondary market so that the private primary market would restore itself. We can talk about the particular details of what's allowed under each facility if anybody is interested. But, just to get to the point, because of the design of the facilities, and because not all types of issues were eligible for direct purchases by the facilities, and not all institutions became registered counterparties to the facilities, we actually have dimensions of heterogeneity to play with. And so in particular, we can think about intermediation activity for registered counterparties versus others. We can think about intermediation by constrained dealers, regulation constrained dealers versus others, and intermediation in eligible securities, again, versus other more risky types of securities. Now, I do want to stress that even though we're focusing on intermediation during COVID-19, we do think that there are a lot of things we can learn from this exercise. The reason why it makes sense to focus on this particular period is, first of all, unlike, let's say, the financial crisis, the COVID-19 period provides a natural experiment in terms of, on the one hand, having an exogenous shock to firm balance sheets. So meaning, it's very hard to argue that the pandemic was the result of prior decisions made by US non-financial corporations. And the other nice thing from a research perspective of this period is that the shock was definitely much bigger for non-financial firms than financial firms. And so you can essentially think about March of 2020 as being a period where non-financial firms were experiencing a large negative shock without a corresponding direct negative shock to dealer balance sheets. As I've already said, the other part of it is that because of the facility design and because there was staggered implementation of how different intermediaries actually became registered with the facility, we can do things like disentangling the effect of credit risk or reduction in credit risk from the effect of the facilities, as well as disentangling the effect of constraints on the dealers from the effect of the presence of quote unquote buyer of last resort in this market. So I'm going to start by showing you results on the extensive and intensive margin of intermediation in secondary markets, and in particular focusing on dealers absorbing order flow from customers selling. Then I'm going to show you how the characteristics of primary market issuances changed over the course of 2020. And finally, to close the loop, I'm going to come back to the question of primary market intermediation over that here. And so for all of these questions, these types of things are relatively long evolving choices. So we can't really do an event study, let's say, for when the facilities were announced. So instead, I'm going to show you results where we take the sample and split it into 4 subperiods. I'm going to have a pre-pandemic period that is going to end on February 21st of 2020, so a month before the facilities were announced. And then a pandemic onset period for the month right before the announcement of the facility implementation period, which is between the facility announcement and the date on which the primary market facility actually became operational, since that was the last part to actually become operational, and then the rest of the year, which I'm going to be calling a facility operational period. In terms of the data, I'm going to lean into the fact that we get the supervisory version of TRACE, so corporate bond market transactions. We're going to be using both the primary and the secondary market data at the transaction level. And the key thing about the supervisory version of TRACE is that we have unmasked dealer identities. So we can do things like actually think about whether dealers are affiliated with US banking companies, whether the dealers become registered sellers of the facility, etc. Since the primary market trades, I think, are used much less in the literature than the secondary market trades tend to be, just one word about the primary market trades. They're basically going to allow us to track this over or under allocation, but not at the bond level. We can actually do it at the underwriter level. So meaning we're actually going to be able to compute, if JP Morgan is underwriting a particular bond together with Goldman Sachs as being an underwriter in the same bond, how much of the over allocation gets picked up by JP Morgan versus how much of that over allocation is going to get picked up by Goldman Sachs. And so for everything, we're going to try to go as granular as we can. So that means that in the secondary market, we're going to be looking at dealer bond date levels. We're going to be looking at issuer week level issuance volumes for the primary market and issue level offering characteristics. And then again, from the perspective of primary market intermediation, I'm going to look at issue underwriter level, and I'm going to talk about both the offering day profit as well as how long it actually takes them to get to a net zero.
Nina,
okay, so yeah.
Sir, in terms of the data, do you have a way to differentiate customer to dealer trades in the secondary market?
Not with this data. So, okay, let me explain what TRACE actually is. So TRACE is the FINRA data collection. It's a mandatory collection for all institutions that are registered dealers in this market. And so whenever a registered dealer trades, they have to send a copy of that transaction record to FINRA. And so in the data, you basically, if it's a dealer to dealer trade, you know the names of both counterparties. If it's a dealer to customer, you know the name of the dealer and you know that it's a customer. Now, in 2017, I believe, they also started, FINRA also started requiring a different flag for a dealer trading with its non-dealer sub. So that's what's called a dealer to affiliate trade. but beyond that, like that's all you know about the customer composition. For a subset of this market, which is the electronically traded subset, if you have access to data from one of the two electronic trading platforms, so either TradeWeb or MarketAxess, there you actually know. You can actually also see the customer-to-customer trades. I don't remember off the top of my head if they normally give you the customer identities, but at least you will see the customer-to-customer side.
Yeah, I don't want to take much of your time, but I think I have seen people doing things like if you see two dealer to customer like in sequence and have like kind of the opposite sign of the same bond, then they label that as customer to customer.
So
I think there.
I mean, yes. So it's possible to do that. There are some. Okay, so if you make that relabeling, you're taking a stand that you know for a fact that the trade happened because two customers came to a dealer and said, like, look, we need to, move this bond between us. It's possible that that was the case, but also it's possible that customer A came to a dealer and said, I need to sell this bond. And the dealer said, look, I'm not going to take this on my own balance sheet. Let me see if I can find one of my other customers that is willing to buy that bond from you. And we're only going to do that transaction. We're only going to do that, the two legs if I can actually find a customer, like a customer on the other side of the market for you. This may be semantics, but to me, the second version is not a customer-to-customer trade. It's a different type of dealer intermediation, but it's still a dealer intermediation. Okay, so in terms of evaluating the effect of the facilities on secondary market intermediation, for the extensive margin, I'm going to look at the probability of a dealer buying a particular bond on a particular date as a function of issuer characteristics, dealer characteristics, and the sub-period indicator. And then for the intensive margin, I'm just going to look at the question of if they actually wind up buying, how much did they buy? And so the observation unit here is going to be a dealer bond day, again, for sub-periods. And I'm going to look at two potential hypotheses in this market. The first is that the corporate credit facilities provide relief to regulation-constrained dealers because they create better market liquidity. So we would expect to see the biggest improvements for bank-affiliated dealers. The alternative hypothesis is that the facilities provide relief through their buyer of last resort nature. So meaning we should expect to see biggest effects for the direct counterparties to the facility because they are the ones that can actually access this buyer of last resort feature. So starting with the question of dealer constraints and probability of intermediation, it is true that bank-affiliated dealers are more active unconditionally, because these do tend to be bigger institutions. But they reduce their intermediation activity in the collateral that's eligible for direct facility purchases once the facilities actually get announced. So in terms of the actual probabilities that are implied by these probit coefficients. So if we look at bank affiliated during the pandemic onset period, the probability of them buying a particular investment grade below 5-year bond on a particular day was around 2%. It drops by 20 basis points once the facility gets announced. For standalone dealers, it goes the other way. They had a lower probability of buying those bonds during the pandemic onset period, higher probability during the facility implementation period. If we instead look at the question of facility counterparties, so again, in general, it tends to be the case that facility counterparties are more active. I mean, I showed you the list earlier on. They did tend, at least initially, they tended to be bigger institutions. Corresponding with them being bigger institutions, they again are going to have lower intermediation activities in SMCCF eligible collateral. But once they actually become registered with the facilities, that probability retraces. So meaning once a institution becomes registered with the facility, especially if they were the smaller institutions that registered later on in 2020, their trading activity actually becomes larger, especially in the securities that are eligible for that are eligible to be sold to the secondary market facility. Corresponding with these probabilities of intermediation, we see very similar effects in terms of the quantities. So the bank affiliated dealers actually reduce how much they're buying these relatively safer securities, and that gets differentially reallocated to the standalone dealers. And this is what my co-authors and I have been calling flight to intermediation safety. So the smaller dealers during 2020 shifted their intermediation activity away from high yield bonds, away from longer maturity bonds into short maturity investment grade bonds, because those securities do tend to be safer. Let me skip that. So in terms of the issuance, again, I'm going to look at the probability of being able to issue for the extensive margin and the issuance terms, so meaning the offering amount, offering spread, etc. I think in the interest of time, I'm going to just show you the results for all firms, but in the slides, which I think are going to get posted, there are also the results that split by firm refinancing need, which you can think about as proxying for the impact of differential minimum revenue thresholds on how firms issue. So looking at the overall issuance, the basic point is that once the facilities got announced, investment grade issuance accelerated very quickly, but acceleration for high yield issuance was much slower. And corresponding to what we saw in the charts at the beginning, the retracement in offering spreads, and especially in offering spreads for high yield issuers, was much slower. So to get to the actual primary market intermediation, I'm going to look at two questions. So the first is going to be just how much does an underwriter earn on the offering day, not taking into account the gross spread that he gets from the issuer themselves. And so essentially, we're going to look at the value of the over allocation that a particular underwriter receives times the number of over allocated bonds times the offering price, plus how much bonds they already resell in the secondary market on the first day versus how many bonds they actually buy on the offering day. The second thing we're going to look at is time to first trading profits after the offering date, which is just going to accumulate the secondary market trading profits for the same bond, the same underwriter in the subsequent days. Okay, so looking at the offering day profits, what we see is that in general, there was an increased compensation for underwriting. So meaning the average offering day underwriting profits rose during the facility implementation period. But that's especially true for, again, these smaller non-bank affiliated underwriters. And what's particularly striking is that if we look at the time to profitability, again measured in days, is that the way in which the primary market and the secondary market slow down, intertwined, translated into a dramatic increase in the average number of days to underwriting profitability during pandemic onset. So especially if we're looking at the short maturity investment grade bonds, which normally we would think about as being very safe because they have a high credit rating, you don't have to wait as long for them to actually mature. The average time to trading profitability was 5 days pre-pandemic. That rose to 14 days on average during the pandemic onset period. And again, that was particularly true for the bank affiliated institutions who were, based on these results, were willing to, actually intermediate in the more uncertain issues in this market. So again, just to summarize what all of these results show is that during 2020, non-bank affiliated dealers, first of all, switched secondary market intermediation activity away from riskier, longer maturity bonds to investment grade, shorter maturity bonds. And because they knew that they were switching their secondary market activity, they correspondingly switched their primary market activity as well. So where again, they were much less willing to underwrite riskier, longer maturity bonds. And again, because they were so reluctant to provide this underwriting activity, they actually wound up earning more underwriting profit, suggesting a flight to intermediation safety in both the secondary market and the primary market, and accompanied by a higher underwriting risk premium. If we think about this from a bigger picture perspective, this also suggests that intermediation by these standalone dealers, at least in the current regulatory environment, looks much more fragile than intermediation by the regulated sector. I would like to wrap up by giving you some of the big picture open questions that I see in this literature. So the first is, the question that I ended with, which is intermediation by non-bank intermediaries. And you can ask things like, as non-bank financial intermediaries become bigger intermediaries in the secondary market, is secondary market liquidity going to become more fragile? Do we think of the type of intermediation that is actually done by the NBFIs as being different? This can go back to the discussion we had with Bruno about matched book trades versus true intermediation trades, where the intermediary takes on the risk of the position for some time. You can also think about how do these intermediaries that participate in different markets, so multi-product intermediaries, form customer relationships. So if we think about a dealer participating in a new market, are they going to want to try to trade with the same clients, because then you don't have to actually spend the search cost looking for new clients? Or do they want to diversify to the extent possible with new clients? And of course, recognizing that not all types of clients are going to be willing to participate in all related markets. And finally, if you're more interested in macro type questions, you can think about things like, how does the composition of intermediaries in the secondary market affect access to credit more broadly, including questions like, do less bank-centric economies have more stable growth? So, if you compare a financial system like the US, which is much less heavily bank dependent to a financial system like the European financial system, which is much more heavily centric, do we think that the cyclical properties of those economies are at least partially driven by the financial sector. And that's all the material that I had prepared, but I'm very happy to answer any questions that you have.
Hi, Nina. This is Xian from UW Medicine. I think this is very interesting talk, and I have two questions for you. So the first one is, I noticed that you have some empirical evidence that the bank affiliated dealers kind of has a lower probability to purchase the facility eligible covered bonds during the after the facility is announced. So could you provide some explanation for that? And the second question is, I think there are other policies implemented after the shocks in March 2020, and there is one particular policy which affects the bank affiliated dealers. So I think that's it's at the end of the March 2020. The Fed has changed the rule of supplemental leverage ratio, and I was interested in. I was wondering, how do you think about this policy will change the dealers' behavior in primary and secondary market?
Great, thanks. So in terms of why we see this relative decrease in probability for bank affiliated dealers, it's true that it's relatively lower, but in absolute terms, it's not that the bank affiliated dealers step out of the SMCCF eligible market. It's more that when the market overall started recovering, they stepped into the longer maturity bonds and into high yield bonds more.
Okay, I see.
So it really is especially during April, May, and the beginning of June, it really does look like that the smaller non-bank affiliated dealers didn't want to intermediate in the risky securities at all, which is why the probability for them of intermediating in the eligible collateral goes up. Whereas for bank affiliated, they were happy to resume intermediation more broadly. And so in terms of the composition of their intermediation activity, for bank affiliated, it shifts more to these riskier securities. For non-bank affiliated, it shifts into the eligible collateral.
Okay, I see.
In terms of the SLR exemption, so I guess there are two ways of thinking about it. One is the direct effect, because the SLR exemption was only for treasuries, you don't necessarily expect to have, you don't have a direct effect of that exemption for corporate bond markets. Now you can then think about, by having this SLR exemption, you're relaxing bank balance sheet constraints more broadly. Does that make them more willing to intermediate? I mean, possibly, but and this is one of those things where it's hard to prove it one way or the other, but we do think that based on the patterns of intermediation before the facilities were announced, it doesn't look like the bank affiliated dealers were constrained in how they were doing corporate bond intermediation. So maybe SLR, accelerates the normalization of the market on the margin, but it's definitely not, like a primary thing.
Okay, I see. Thank you.
So I'll have a question, a little bit tricky question. You use a lot of regulatory data. So for someone that's maybe coming from a university and wants to work on this topic, what type of data do you think that people could start on to get?
Yes. So I mean, in terms of this particular market, there is now enhanced trace that is available, to people at universities. The difference between enhanced trace and the supervisory version of trace is that the enhanced trace, I think, gets released with a year lag, I believe, or something like that. And so, yeah, you're not going to be able to, like do the analysis in real time. So most of the analysis that I showed you was actually done in 2020. But from the perspective of actually understanding how these markets work, I mean, so what if you lose like the latest year of data? You can still think about those questions. And then the other thing I will say is, in terms of these new trading platforms for credit, so TradeWeb and Market Access, because they are not regulated entities, they do actually sell their data to academics. And those types of platforms, I think, provide the same data to academics as they do, when the Fed buys the data. So you just have to, figure out what your university is actually subscribed to.
Any other questions? Sorry, Rui, your volume is too low. Can anyone hear? I cannot hear, sorry.
Yeah, I can't either. If you want to type your question in the chat, we can just read it out too. Yes. Okay, so Roy is asking if I can explain the delta in the model. If I go back to, oops. Okay, so if I go back to this, I mean, let me give you the technical explanation first, and then I'll go back to the question of what it's actually capturing. So this type of model is a, it's a learning model where the agents are allowed to learn from the price. And so in these types of models, you need to have something in place that makes the price not reveal the information perfectly. So if we look at the equilibrium clearing price, the equilibrium clearing price has this form of the average, the average signals, the average private values, and this extra essentially error term. And that error term, again, from a technical perspective, is important to have so that an agent can just look at the price and infer perfectly what the beliefs of everybody, or what the information says of everybody else's. Now, there are settings in which that extra noise term is literally just added on as a technical condition, recognizing that, look, we need to have this to make the model interesting. In settings like this, there is actually a fundamental reason to have that price. I mean, here I'm calling it price insensitive demand, to have that error term. First, from the perspective of the participants in the primary market, you are going to have these traders that have to buy the issue no matter what. And so, because they have to buy the issue no matter what, their demand is going to be price insensitive. And so from the perspective of the price revealing information, everybody's information, you can think of these price insensitive traders essentially providing that error term. Now, for the corporate bond market, there is actually also this thing of the issuer, does have a say in how much gets issued. And so even on the offering day, there will sometimes be renegotiations between the issuer and the underwriter in terms of, look, we're doing this offering, the offering is going great. We can, are you sure you don't want to try to issue more? Or, we're doing this offering, it's not going as well. I think we can only raise, 90 million out of the 100 million you were trying to raise. So in the corporate bond market, there is also this extra error term that can come from, decisions of the issuer. In what I showed you today, I'm not I don't have that channel, but you can also definitely think about the deltas coming from that as well. The paper I took this model from is for US Treasuries. In the US Treasury market, again, it actually makes sense. There is an explicit category of traders in the US Treasury auctions that literally just admit, I need 10 million of this issue. I don't care what the price is. So it really is an actual feature of the market as well.
Oh, hi. Given that you just talked about the treasury market, I have a bit broader question, and maybe you know about this. So in the treasury market, there's this on and off the run premium. And so this was higher during the Corona crisis. And so there was this big treasury market discussion that the dealers didn't want to take the treasuries into their inventories. So would you say that that the on and off the run premium could potentially be a measure for how much constrained the dealers were, or is this completely dependent? Or
yes, so it is that the on the run off the run spread is definitely related to dealer constraints. It's not so okay, but dealer constraints are not the only thing that that drive that spread. So because essentially for the on the run spread, excuse me, that calculation assumes that you can fund both legs of that trade, right? So going long in the on the run, going short in the off the run. Sorry, vice versa, going long in the off run and going short in the on the run. In practice, you would do that through a repo leg and a reverse repo leg. So dealer balance sheet, dealer constraints enter that, because especially under current regulation, both doing a long repo, doing a repo and doing a reverse repo is very balance sheet expensive. So it's definitely going to be a factor. Now, the interest rate at which you can do, again, repo, reverse repo is going to be determined both by dealer balance sheet constraints and the constraints of, the end providers of cash. So think money market mutual funds.
thank you.
Okay. I think I will end the lecture now. Thank you, Nina, for the great lecture. Thank you for your time. We are going to be posting this lecture the next few days. I'll try to to post it today, but and I will mail everyone so you can access it again. And then in our website, we also posting the slides as soon as we have a final version to post. But thank you everyone for coming, and we are sending information for a new lecture soon. Bye.
Bye.